We'll be having that conversation with IFGL Refractories. I think Mr. Sarda is back with us. Good to have you back, Mr. Sarda. You are addressing our query on what can you do for the year from Sheffield. You already told us 1,700 to 1,750 crores for the consolidated entity. How much will Sheffield contribute? Last quarter, you did more than 50 crores. And also, you briefly mentioned about some new products that you're launching as well. As a percentage of your total revenues, how much will they contribute?
Sheffield, it is only February we acquired that company, so it is into integration stage, and it is giving a smooth performance, I would say, a positive contribution to us, and it contributed about 50 crores in the quarter 1, and I think this run rate will be maintained in the full year also.
Okay, so 200 crores then for the year?
Yes, about about that, yes.
And you also briefly mentioned about some new products that you were going to be coming up with. Could you give us some further details on that?
So Sheffield is into blast furnace and on the iron side mainly, and on steel also. So these products, once the company is integrated fully into the system, we will launch these products maybe towards the end of this year or early part of next year.
All right. Even at full capacity, Sheffield does around 200 to 220 crores per year itself, is it?
No, Sheffield, I think they can produce more. They have the powder material, they can produce more, yes.
How much more can it produce, and what could the peak revenue from Sheffield be for you?
Peak revenue, I think we still have to work on it. We are still into the integration stage, as I mentioned. But I think it can go much higher than what it is doing today.
Okay, and are you still open to inorganic growth? Because I remember the last time you joined us, you said you're always open. But now that you're integrating Sheffield into it, will that be the management's focus, or will you also on the side look for some opportunities both in India and overseas?
No, we are always on lookout of opportunities. I think there are some talks going on, but I think these keep on going on. But we will be open to any good opportunities in the future.
Okay, what could the size of the opportunities be? And also, where will it be, in India or overseas? I'll tell you why, Mr. Sarda, because, the street gets a little bit cautious when you go ahead and try to acquire businesses overseas. Sometimes they are a little bit volatile, so that's the reasoning. So could you give us a brief idea about the size, and what would your geographic preference be?
Size, with the kind of balance sheet we have and the cash balances we have, I think size is not a big constraint today. And also on the geography front, if you look at our history from 2005, when we partnered with Monocon, when we acquired Monocon, all our acquisitions have been quite smooth, and none of them have, rather all of them have done quite well. So we don't have any problem in going into any overseas market to acquire.
And
but our focus is Europe and US, I would say.
Europe and US. Okay, and the cash on your books, you said, is how much? Because, size is not a problem, is what you're saying. As of now, what's the cash?
So, I think today in our group, we have 200 crore plus cash.
200 crore plus.
But you also have a capex of close to around 170, 180 crores, right?
Yes, we have, but we have also tied up for a term loan. So partly out of the internal accruals and partly out of the term loan. So we are retaining the cash for any kind of opportunity which can come in.
All right, and finally, before we let you go, contribution from exports. Earlier, it was 60%, it's come down to 45%. Will this mix stay around these levels, or will you see more coming in from exports? Just wanted to understand what is more lucrative for you, exports or domestic market?
See, the margins are very, very similar levels for both domestic and exports. But our focus has been in the past couple of years has been more on domestic market. But Europe, if you look at the Europe's last 2 years, Europe has been quite subdued because of the Ukraine conflict, I would say. The CIS countries also contributed quite a bit for us, but that has been subdued for us. We are hoping that this all will come back to us in the near future. So export will also be ramped up quite fast once they come back on stream. But our focus, the increased focus will be on the domestic market.
The street would like to hear that because otherwise in the past they've been quite disappointed. Final question before we let you go. What is the demand scenario? How is it playing out currently, particularly on the global front? India, I think I'm reasonably updated out there. But on the global front, is it strong enough? Is it a little bit weak, Europe and America? And also on terms of pricing, there has been some pressure on pricing because input costs have gone down. Do you see a sharper correction here?
The market in US is quite good. Europe is, I think, planning to come back. We are hoping that H2 should be better than H1. So that will give us a bit of a, good market for H1 and FY25. On the margin front, I would say, yes, the input costs are softening, and then correspondingly the input prices the realization are also getting corrected. But margins would remain intact.
All right, margins would remain intact. We'll keep an eye on that. Thank you, Mr. Sarda, for joining in. Wish you good luck for the remainder of this year and the future as well. Hope you ramp up all the capacity at Sheffield and get the acquisitions that you're eyeing as well. Thank you for joining in. Well.